Hello there, my name is Wale Farah. I'm a tech entrepreneur, and you are watching Tech Roundup, your weekly opinion, views, and analysis of the top tech events happening around the world with a focus on Nigeria. In our analysis segment this week, I have Eyitayo Ogunmola, the CEO of Utiva, who will analyze the following stories with me. We'll review Australia's new decision to water down their lending regulations. And finally, we'll review the latest Mckinsey report that says Nigerian Fintechs have raised $600 million in the last 5 years. It's a packed show, so let's get started. Recent reports say that Australia plans to simplify lending rules to free up credit in a bid to stimulate the economy, which slid into its first recession in nearly 30 years due to the coronavirus pandemic. The changes will ease the regulatory burden and reduce the cost and time faced by consumers and small businesses seeking access to credit, said the Federal Treasurer. However, some consumers say the government's proposed reform will remove bank responsibility to customers, opening up new opportunities for banks to aggressively sell debt. Critics argue that it will result in credit arrangement that will ultimately hurt individuals and businesses in the long term for a short-sighted quick fix of a failing economy. Bank lending in Nigeria has its issues as individuals and businesses have had to overcome many hurdles in order to be granted loans. Loan repayment and recovery is another huge problem, hence the need for collaterals to secure loans. We've also recently seen the impact of technology in the space. We now see many banks who offer loans via USSD technology and other digital banking or lending services. We're also seeing, these services taking the spotlight. However, there are many issues and areas of improvement that can provide more access to credit to boost economic recovery. To discuss this, let's bring Eyitayo. We all know the challenges of getting, access to credit in Nigeria, whether it's microloan or the big one for big businesses. And I just wonder if there has to be a shift as well, driven by the CBN to the banks and other fintechs who are giving out loans for them to be able to make access to loan easier, for businesses especially. I'm just wondering what your take is on this and how we can use what's going on in Australia as a lens to start to restructure the credit, the credit process and access to lending for businesses and individuals, especially at this time when we need to really stimulate economic recovery in Nigeria.
When a country wants to get out of recession, it's a totally different strategy as against the lending policy that you put in place when a country is economically doing well or economically viable. We need to think about this from three major perspectives. Number one is the bank. The CBN needs to understand that the banks are major players when it comes to risk assessment, data capturing and also data exchange among multiple players. And the second thing is that the micro actors in terms of the SMEs and also individuals, organizations that are accessing those loans also needs to be engaged properly, so that we understand that this is a new terrain, it's a new dimension, it's a new time, it's totally different from what we have done in the past. So we need to be quite very flexible in terms of the way we help SMEs, I'm emphasizing SMEs and startups, because these are key drivers in terms of quick recovery, because almost 60% of human capital in Nigeria, for example, are hired by SMEs and startups. So I would really encourage that the CBN understand that, these startups and SMEs have a new type of ball, within their court. So they need to be engaged more effectively in terms of helping them understand, the new structure for accessing credit.
A recently published Mckinsey report discuss the advances made by fintech companies in Nigeria, and also discuss the huge potential that the space presents to the economy and stakeholders. I strongly encourage you to read the full report on TechRoundUp3E11. The report also revealed that Nigerian Fintechs have raised over $600 million in funding in a space of 5 years. The report highlighted some of the factors that make Nigeria conducive for Fintechs to thrive and their limitations as regards focus areas and user experience. The most interesting part of the report, as far as I'm concerned, talks about fintech repositioning for the future and the role of regulators in driving growth in the space. To discuss all this, what's going on in the fintech space, let's bring back Eyitayo again. So if we move to the second story, there was a very interesting article or report by Mckinsey, the consulting company, focused on fintech landscape in Nigeria. There was conversation around banks and how banks are sort of collaborating or competing with fintechs, and how banks need to sort of realign their business model to focus on increasing the size of the market rather than protecting what they have right now. And then there was a part around regulators, what regulators should be doing, opening access to actually regulate fintechs. Fintechs are not banks. I hear that CBN is coming up with a new license regime specifically for fintechs. I'm eagerly waiting what that looks like and how that would differ from the existing licenses that are required to operate in this space generally. I just wonder, how you see this interesting space. What challenges you think players should focus on, including the incumbents and including guys who are thinking about coming into this very interesting space that we're playing in right now.
But I want to think a little bit different from what the report feels or what the report says.
Okay.
This is the way I think about growth when it comes to like the fintech. We should not forget that this report highlighted some areas like, poor user experience as an hindrance when it comes to adoption.
Mm-hmm.
The fintech is beautiful, but when you think about adoption, the overwhelming value added from some of the product that has been rolled out, the low returns when it comes to the fintechs that are focusing on savings, or credit, with limited access to investment opportunities. So the bank needs to wake up to the reality that the fintech has not even started yet. There's a whole lot to do. There's a whole lot. So the bank should not position itself, or let me say smart banks shouldn't position themselves as direct competitors to the fintech. The bank should position itself as advisory, as a platform for providing data, a collaborator to the fintech. And the earlier this is done, the faster the fintech is able to navigate, because one of the beautiful things with the fintechs that the traditional banks may not be able to do is that nimbleness. So, and also think about it from this perspective, Wally, the fintech is a ripple effect of the great work that the CBN, the Bankers Committee, the entire financial industry has done. So the reason I lived in the US, I lived in the UK, and sometimes I just think about it like the Nigerian fintech industry is an awesome sector. I think the bank needs to open up more to access or to receive the fintech from transformational perspective, and the bank can provide advisory, can provide capital, can provide, what I call the OPM3, organizational project management maturity. Finally, let me succeed, the bank succeed too, because think about the movement of cash, right? The fintechs don't save money, they don't put money in their accounts. Ultimately, this money goes to the bank, and the bank has to be smarter in terms of the way they partner with the fintech.
That's all for this week. Have a good week, guys.